timing-wise, this phone call definitely signals momentum towards that tactical trade de-escalation thanks to Geneva. But we should be cautious about assuming a broader strategic breakthrough. The market is probably later focusing trade deal optics, and something recently is about a rare earth resolution and upcoming meetings between the two sides. But you and I both know, if you read what Beijing announced after the meeting, China's readout focused more on structural issues, including on the tech curves. That tells us the bid-ask gap remains quite wide. It's not a surprise that China wants a grand bargaining deal, a strategic reset that covers not just the trade, but tech and geopolitical issues, not just a narrow tariff deal. But this mismatch means while the U.S.-China trade talks are expected to initiate quite soon, given the current truth, some more momentum, some more time, but it may not resolve the underlying tensions. And our assumption is the effective U.S. tariffs on China are anticipated to stay at a terminal rate of probably 30 to 40%, similar to today's rate, by the end of this year. This is in comparison to that 11% prior to 2025. And this level is still quite high, right? And they will cost corporates some margins, they will cost them some confidence in investment. So that's still there. And the last but not least, this tactical deal, while it's possible on the trade side, the strategic risk uncertainty remains elevated given just how much differences, divergence, narratives between the two sides are still there.
So we're focusing in on the readouts from both of the presidents, and President Trump used vague language and suggested that Beijing had agreed to ease its strategic grip over rare earths, which are, as we all know, essential for a broad range of consumer, semiconductor, high-tech, as well as military technology as well. But we know that this is something that is controlled by China. They have 92% of the world market share in rare earths and can use this as leverage. It's the trump card, if you will. Pardon my pun. It's the ace in their hand. Do you think China will ease up on the controls that it's had? I mean, we've been reporting this week that they're tightening the controls, making sure that companies, they report how much is going out, who's shipping it out.
Well, that's a $1 trillion question, given how important this little rare earth could matter to supply chain. However, that's exactly when you compare the statement between Beijing's readout and the U.S. readout, one thing differs a lot is Beijing completely omit the mentioning of rare earth in the readout. Yes, as you said, President Trump mentioned the rare earth probably being gradually resolved, but Beijing didn't mention rare earth at all. Instead, Beijing's readout focused a lot on structural issues, including the tech curves and the geopolitical concerns. So I think there is still quite wide, bid-ask gap between the two sides. And so far, even if they can try to give some momentum to the ongoing trade talks, anything beyond tariffs, from geopolitics to tech to this recent supply chain thing, there is still a lot of underlying uncertainties here.
Rare earths are key for use in electric vehicles, and the Trump-Xi phone call was overshadowed by the stock market loss in shares in Tesla. We saw a huge sell down in Tesla shares. Now, I bring this up because I want to talk about EVs. Tesla, of course, a big player in the Chinese market, but now at risk of getting a federal EV tax credit being removed by President Trump. On the other hand, we're looking at a very competitive EV space in China. Talk to us a little bit about how the EVs and the market on the whole, with all the BYD price cuts. We're seeing this dumping in the auto dealers. How is the EV space in China?
That's a great question. There has been some very dynamic, interesting tech sector in China. Part of this animal spirit is back. You can see it from Hong Kong's IPO market. However, Meanwhile, elsewhere in the broader economy, housing or conventional consumer sector, China is still stuck with deflation. So that's because China's rebalancing away from this supply-centric policy approach towards consumption-centric. The progress in that rebalancing has been quite slow. China needs more reflation and rebalance, but the policy remains quite cautious, fragmented, and supply-side focused. The thing you mentioned, the EV, basically throat-cutting price war is one example of the deflationary pressure recently. We have seen some front-loaded fiscal policy support for things like consumer goods trade-in program, but they need a fundamental, deeper social security reform to build social safety net for farmers, for migrant workers to unlock precautionary saving. And that could boost the consumption in a more sustainable way. But on that front, I think the progress has been relatively slow. That's why so far deflation is still the key word for this year. About 2 weeks ago, we have upgraded China's real GDP forecast for this year from 4.2% to 4.5%. But that's real GDP, that's volume growth. For nominal GDP, given this persistent deflation pressure, we maintain it at around 3.5%. So nominal GDP growth will be at subdued level given this persistent deflation pressure, and the EV car is just a part of it with all these supply-centric policy approach.
One more question about EVs, and with BYD cutting prices by as much as 30%, and then some of its rivals also following suit. What does this do to the supply chain? How can they afford this?
I mean, part of the problem is just, I would call it a path dependency. If you look at local government incentives in China, a lot of it is about the KPI is GDP. GDP is production-based. The local government revenue largely rely on indirect tax, things like value-added tax, which is largely from production, not from household income. So all of these incentives means for local government, they still want to give a lot of industrial policy support to from EV to battery to maybe other emerging sectors. And with that kind of mentality, it's very easy when you have one successful firm in Shanghai, the other cities in inland China want to replicate that success with even more tax rebates or industrial policy support. And over time, that creates overcapacity. So that's why we kept proposing China need a fundamental change from that supply-centric approach to consumption-centric, by shifting government resources and the incentive and the KPI from production or infrastructure-based metrics to something more about people's social welfare, about consumption and the services. But that takes time. So far, we have seen some baby steps on social welfare system, on the consumer goods trade-in program, but these are not enough to fundamentally reflate. That's why I think what you mentioned, that deflationary pressure will be here to stay with a subdued nominal GDP growth throughout the rest of this year.
Talk to us about the data that you expect to come through from China. Of course, with the trade pause, there was front-loading by many of the companies, by countries. China is the United States' biggest trading partner as far as the Port of LA is concerned. I got a chance to speak to Gene Soroka, who runs the Port of LA, and he says that previously China made up 60% of their business, and now that has dropped to 45%. How do you see that that dynamic continuing to change, and how do you read it in some of the data that you're seeing in terms of the exports and other numbers?
Thank you, Emily. I'm glad you mentioned the Port of LA. So we created some product called Transporting based on high-frequency data to track China's economic sentiment. You are right. So on exports, these 90 days U.S.-China tariff truce triggered a surge in this outbound shipment demand, particularly on U.S.-China names. Freight rates, for example, have jumped in the last 3 weeks. And outbound container volumes are peaking probably in early June. All of this means that this front-loaded exports is going to support second quarter GDP. Q2 GDP is tracking at probably 4.8% year over year at quite robust level. But all of these are just the front loading of exports. And that means after the 90 days detente expire, we may see some payback. These exports growth and all these government subsidy on consumer goods, they may start to fade. We will see that payback in the second half of this year. This is all part of the reason, despite we revised up China GDP forecast for nominal GDP and deflation, we think they will be quite persistent.
I think you can see this, Robin. I'm holding, this is the Kita drone, and they launched the drone services in Hong Kong today, a highly competitive market. Meituan, of course, is the parent of Kita. Kita is the company in which it operates in Hong Kong. I bring this up because I want to ask about Meituan, JD.com, Alibaba. There is the shopping festival that's going on, 6/18, and we've heard from Alibaba and JD that so far the sales are pretty decent. What are you seeing on the ground? What are you hearing in terms of the strength of the consumer and how the shopping festival is performing this year?
I think it's a tale of two economies. One is what you mentioned, a very dynamic tech economy. People are trying to innovate. And every other week you heard more progress, either on self-driving cars or on the drones or next generation of batteries or the other model by DeepSeek. However, if you look at conventional consumer construction and the housing sector, I believe they are still stuck with deflation. So this is a tale of two economies. Fundamentally, they need to do much bigger rebalancing efforts to boost the consumption in a more sustainable way. We are not there yet. But before we can achieve that reflation moment, now I think as investors, people will try to be selective, focusing on the bright spots. And as you mentioned, the new consumption is one of the bright spots. In fact, about 3 weeks ago, when I was in Paris attending Morgan Stanley's European Luxury Conference, a lot of European investors and corporate executives asked us about Labubu, about Chinese gold jewelry brands taking market share. I think this means even with the deflation macroeconomy, there are certain tech and new consumption trends. People try to be selective to find these bright spots.